let's start discussing the tax-based definition of a liability in terms of IAS 12. Just quickly, basic concepts now from a liability perspective. On my balance sheet or statement of financial position, I will have recorded a liability. Now, what does that liability represent? Well, in essence, there will be an obligation and there will have to be future outflows to settle that obligation in terms of the definition of a liability. Now, attached to those future outflows, sometimes the tax consequences may not be the same as accounting. Therefore, there may be future outflows that may have tax consequences or tax deductions. Now, those tax deductions are a future economic benefit, and what do we do with future benefits? Well, ladies and gentlemen, future benefits in essence are assets. So if there's a liability that this arises for, there should also be a tax asset that is recognized along with my carrying amount of my liability, whatever that may be, a loan or a provision. Great, so basic concepts understood. IAS 12 paragraph 8 gives me the definition of the tax base of a liability now. So here it says the tax base of a liability is its carrying amount minus any amount that will be deductible for tax purposes in respect to that liability in future periods. Quickly, diagrammatically, let's have a look. First of all, identify the future outflow of resources. So let's work on two scenarios here. Let's say we have our normal trade payable or creditors. What is that going to be? A future outflow of cash, so a future payment. So it'll definitely be a future payment. Let's have a look at provisions. Provision for leave pay. Also a liability, but here there's going to be a slight difference in the tax treatment, which you'll see now. The future outflow, what's exactly the same as a creditor? There will be some type of future payment expected. Now, the next question, which you need to start thinking about quite diligently here, is that future outflow tax deductible when it's made in the future? So for creditors, will that payment in the future be tax deductible? No, because you've already claimed the tax deduction when you actually receive the invoice from your supplier. So that will definitely be a no. For our provisions, will that future payment be deductible? Yes, because for majority of provisions, well, the tax authority does not let you take the deduction when you are journalizing the accounting expense. Why? Because provisions are, well, it's a liability of uncertain timing or amount. The tax authority does not put much weight behind that. So provisions, the tax authority says, fine, account for it whenever you want, but your provision for leave pay you'll only get as a deduction when you actually pay out an employee who's leaving. So there's your provision, yes. So there's actually a generic definition here. The tax base of a liability is carrying amount minus the future tax deductions. Okay, we're going to look at an example with both creditors and provisions, and what you'll see is if the answer was no, the same definition, okay, the definition leads us to realize that the tax base will just land up equaling the carrying amount. So then there'll be no deferred tax. Let's quickly look at those rules like we did for the assets. So this is different to what it was for the deferred tax of an asset or tax base of an asset. So here, the carrying amount of a liability, if it is bigger than the tax base of a liability, you will have a deferred tax asset and the related deductible temporary difference. If the carrying amount of the liability is smaller than the tax base of a liability, then you will have a deferred tax liability which arises from a taxable temporary difference. Learn these rules, please. So let's have a look at a basic example. Let's start off with the provision, because provisions do give rise to deferred tax. So if I have a carrying amount, let's say of 1,000 for a provision. And let's say it's a provision for leave pay. That carrying amount is going to be a future outflow. The next thing you've got to ask yourself is, what is the tax base of this liability? Well, the tax base of a liability is equal to the carrying amount minus the future tax deductions. I've given you the carrying amount already. The accounting carrying amount was 1,000. Now, when will the tax authority give you the tax deduction? Well, for this provision, he's not going to give you the deduction when you account for the expense, when you go debit, expense, credit provision. For provisions, he's going to give you the deduction when you make the payment to an employee who's leaving in the future. So the future tax deduction is going to be 1,000. Tax base of a liability, therefore, equals nil for this provision. So tax base is nil. Remember how we do this? Carrying amount of 1,000 minus the tax base will give me what? My temporary difference. And that temporary difference here will be a 1,000 amount, and that 1,000 will be a deductible temporary difference. Okay? Deductible temporary difference means that there will be a future tax deduction, and a future tax deduction is definitely a future benefit. So my deferred tax, let's say we are working on 30% here. My deferred tax will be 300. Will it be an asset or liability? Let's think. A future tax deduction will mean a future benefit, therefore a deferred tax asset. Great. Hope you understand that. Let's now look at a creditor. So what's the difference between a creditor and a provision? Well, a creditor, you've already been invoiced by a supplier, okay, and there is a very definite present obligation. Okay. So let's understand the carrying amount of this creditor. Let's use the same figures, 1,000. Okay. That is going to be a future outflow still, a future payment. So let's take my tax base of a liability definition, and I'll have my carrying amount minus my future tax deductions. Carrying amount, 1,000. Minus the future tax deductions. Well, let's think. When did I get the tax deduction? Well, it's already happened in the past, where I went debit, expense, credit, creditor. I received an invoice. There was a accrual, and the taxman said, use that as the timing for your deduction. Remember the tax authority deductions at the earlier of accrual, okay, or payment. So 1,000 minus 0. There's no future tax deductions left. They've already occurred. So tax base equals 1,000. Bring my tax base in here as 1,000. And straight away you can see that my temporary difference is nil, and there will be no deferred tax. Great. Now, learn the difference between an asset and a liability tax base, as well as the different rules that will apply. Please understand that income received in advance is conceptually a liability, but due to the nature of an income received in advance and its tax treatment, okay, it is not taxed in the same way as a liability. So what happens is we need a different tax-based definition. That's in the next video. Please don't assume that income received in advance is treated the same as a liability for tax-based definitions. Thank you.